While everyone was chasing the next AI stock, a company that most people thought was dead just pulled off one of the most explosive earnings surprises of 2026. I'm talking about a stock that's up 131% this year, but according to some analysts, it's still trading at a 60% discount to its true value. Sounds too good to be true, right? Well, stick around because today on Smart Stock Sam, we're diving deep into Sandisk's incredible transformation, and more importantly, answering the question everyone's asking. After this massive run-up, is Sandisk still a buy, or are we looking at the top? By the end of this video, you'll know exactly what the smart money is doing, where the stock is headed next week, and whether you should be jumping in or staying on the sidelines. Let's start by looking at the numbers that literally stopped Wall Street in its tracks. On January 29, 2026, Sandisk dropped their second quarter earnings report, and let me tell you, this wasn't just a beat. This was a financial earthquake. They reported earnings per share of $6.20. Now you might be thinking, okay, Sam, that sounds good, but what were analysts expecting? Wall Street was expecting $3.62. That's a 71% beat. When was the last time you saw a multi-billion-dollar semiconductor company crush estimates by that margin? But here's where it gets even crazier. Revenue didn't just grow, it exploded 61% year over year, blowing past $3 billion. And the catalyst behind all of this? Something analysts are calling the Great Memory Crunch. Every major AI infrastructure builder on the planet is scrambling to buy high-performance memory. And guess who's sitting at the center of this supply bottleneck? That's right, Sandisk. Their data center revenue alone surged 64% sequentially. But hold on, because there's one hidden metric buried in these numbers that changes everything about how we should value this company, and we're going to reveal that in just a moment. Before we get to that game-changing metric, we need to understand how Sandisk even ended up in this position. Because just over a year ago, this company was part of Western Digital, struggling to find its identity in a brutally competitive storage market. In February 2025, the strategic separation from Western Digital was finalized. At the time, most investors yawned. Just another corporate spin-off, right? Wrong. What happened next was nothing short of brilliant. Throughout 2025 and into early 2026, Sandisk's management executed a laser-focused strategic pivot. They stopped trying to compete in every corner of the storage market and instead went all in on 3D NAND technology, specifically designed for AI infrastructure. They transformed from a legacy hard drive company into what Goldman Sachs is now calling a premier AI infrastructure powerhouse. And that January 29th earnings report? That was the moment Wall Street finally woke up and re-rated this entire company. Now let's break down the actual numbers that sent shockwaves through every institutional trading desk. When you compare the consensus estimates to what Sandisk actually delivered, the gap is absolutely staggering. We're talking about a 31% sequential revenue increase. In the world of multi-billion-dollar semiconductor firms, you typically see mid-single-digit sequential growth. This kind of velocity is almost unheard of outside of the Magnificent Seven tech giants. But here's the thing that separates the amateurs from the professionals. Revenue is vanity. Profit is sanity. Sure, growing revenue by 61% year over year is impressive, but when you beat earnings per share estimates by 71%, you're not just doing well. You've discovered something incredibly rare, genuine pricing power. And that pricing power, it's showing up in the most beautiful place possible. This right here is what I call the holy grail for growth investors. Look at how Sandisk's gross margins have evolved. Back in the first quarter of 2025, gross margins were sitting at a modest 32.5%. Now flash forward to the first quarter of 2026, and those margins have rocketed to 51.1%. We're not talking about a temporary spike. This is a structural reset in profitability. The company isn't just selling more products, they're selling more efficiently and at higher prices. GAAP net income hit $803 million, which represents a mind-blowing 672% increase year over year. When margins expand this aggressively, it tells us something critical. The memory crunch is absolutely real. Customers have stopped negotiating on price. They're literally begging for supply. And in case you're wondering if this is sustainable, well, we need to look at who exactly is driving all this demand. The engine powering this entire growth story is Sandisk's Datacenter segment. This division is now generating $440 million in revenue and growing 64% quarter over quarter. But here's the part that should make long-term investors really excited. Sandisk just announced that they've been qualified by a second hyperscale customer. Translation? Another Magnificent 7 caliber cloud provider is about to start funneling hundreds of millions of dollars into Sandisk's revenue stream. As revenue recognition begins from these additional cloud giants, the data center segment could easily become the majority of their entire business by this time next year. And if you think the second quarter numbers were impressive, wait until you hear what management is projecting for the next quarter. Management just issued guidance that frankly sounds almost too aggressive to believe. They're forecasting a near doubling of profitability in the third quarter. Revenue is expected to land between $4.4 billion and $4.8 billion, with earnings per share potentially jumping from $6.20 all the way up to $14 per share. How is this even possible? According to their guidance, NAND average selling prices, what the industry calls ASPs, are expected to soar another 50% next quarter. If they hit the high end of this guidance range, we're not just looking at a growth stock anymore. We're looking at a legitimate cash flow printing machine. And naturally, the market has responded to all this news with extreme force. The price action on this stock looks like an absolute launchpad. Following that January 29th earnings bombshell, we saw a massive 20% gap up. And here's what's really interesting. Since then, the stock has completely refused to fill that gap. It's currently trading around $626.56. That represents a 51% return in just the last 30 days. Now, normally, I would be the first person to tell you to be extremely cautious about buying a chart that's gone completely vertical. But we have to ask ourselves the critical question. Is this price action driven by hype and momentum, or is it actually being supported by genuine fundamentals? To answer that, we need to look at what the smart money on Wall Street is actually saying. The Wall Street consensus on Sandisk is about as unanimous as you'll ever see. We're looking at a strong buy rating with 13 buy ratings and 0 sell ratings. Bernstein has slapped a price target of $1,000 on this stock. Cantor Fitzgerald and Citi are more conservative at $800 and $750 respectively. Even retail sentiment on platforms like Reddit and StockTwits remains very bullish. But here's what's really fascinating. Even these $1,000 price targets might actually be conservative if this AI memory supercycle continues at its current trajectory. And when you look at the math behind the cash flows, the numbers get even more interesting. This is the big payoff of today's analysis, so pay close attention. If you calculate Sandisk's historical fair value based on traditional memory cycles, the stock should theoretically be trading around $265. But here's the problem with that approach. We're not in a traditional cycle anymore. When you run a proper discounted cash flow model that actually accounts for this AI-driven memory supercycle, the intrinsic value comes out to over $2,000 per share. Even at its current price of $626, Sandisk is trading at a forward price-to-earnings ratio of just 14 to 34. Compare that to other AI darlings like NVIDIA, and Sandisk looks genuinely inexpensive. You're essentially getting hyper-growth at what many would consider a value stock multiple. But before you rush out and buy, we need to talk about the risks, because no investment is ever a sure thing. Let's start with the good news. Sandisk has built an absolutely massive competitive moat. Their strategic partnership with Kioxia has been extended all the way through 2034, which secures their 3D NAND manufacturing capacity for the next decade. Goldman Sachs research suggests this global memory supply crunch could persist through 2028. This supply constraint is creating what Sandisk calls a margin floor, where they expect to maintain gross margins between 65% and 67% going forward. For context, Those are margins that would make even software companies jealous. However, and this is important, we absolutely must address the risks that caused a brief sentiment dip on February 10th. Competition in this space is heating up rapidly. Samsung is aggressively accelerating their HBM4 production, which spooked some investors recently and caused a temporary pullback. Beyond that, this stock is extremely volatile. We're regularly seeing single-day price swings of 7 to 11%. These are what traders call air pockets, where liquidity temporarily dries up and prices can move violently in either direction. If management misses that $12 to $14 earnings per share target for next quarter, or if gross margins dip below 60% for any reason, the correction will be swift and absolutely brutal. So how do we navigate this volatility if we actually want to trade this stock next week? From a technical perspective, the chart suggests we're currently in a consolidation phase following the massive post-earnings run. We're seeing those liquidity air pockets I mentioned, where the stock can move rapidly between support and resistance levels. The current price action suggests the stock is coiling up before its next major leg, either higher or lower. Because the beta on this stock is so high, you absolutely cannot just hit the market buy button and hope for the best. You need a disciplined, well-planned entry strategy. And fortunately, the options market is giving us a very clear roadmap of where the smart entry points actually are. When we examine the options chain for contracts expiring February 20th, we see something really interesting. There's a massive concentration of put open interest at the $600 strike and call open interest at the $650 strike. This creates what's known as a pinning effect. Market makers who sold these options need to hedge their positions, which tends to keep the underlying stock price trapped between these two strike prices as expiration approaches. This gives us a high probability trading range to work with for our weekly setup. So here's the exact game plan for the next 5 trading days. Before we wrap up, I need to make something crystal clear. Nothing in this video should be considered personalized financial advice. I'm not a licensed financial advisor, and I don't know your individual financial situation, risk tolerance, or investment goals. This analysis is purely educational and intended for informational purposes only. The stock market carries significant risk, and you can lose money, especially with volatile stocks like Sandisk. Always do your own thorough research and consider consulting with a qualified financial professional before making any investment decisions. For the trading week of February 17th through February 20th, we're looking for a limit entry around $620.50. This level sits right near that put support wall we identified in the options chain. If we can get filled at this entry, our upside targets for a potential range breakout are $653.80 to $661.50. However, because of the extreme volatility in this name, you absolutely must have a hard stop loss in place. We're setting that stop at $585. This protects us in case the stock decides to violently break below its recent consolidation range. So here's the bottom line. Sandisk is undeniably the fundamental winner of 2026 so far. The transformation from legacy storage company to AI infrastructure powerhouse is complete, and the numbers prove it. With a unanimous strong buy rating from Wall Street, margins expanding to levels we haven't seen in this industry, and a supply crunch that could last years, the bull case is extremely compelling. However, at $626, after a 131% run, timing your entry is absolutely critical. If you're considering a position, wait for that pullback to $620, set your stops, and size your position appropriately. The opportunity is real, but so is the volatility. If you found this analysis valuable, smash that like button and subscribe to Smart Stock Sam for more deep dives like this. Drop a comment below and let me know. Are you buying Sandisk at current levels, or are you waiting for a bigger pullback? I'll see you in the next one.